Imagine buying your dream car, a Tesla perhaps, without taking out a high interest loan or depleting your savings. What if I told you there's a way to finance your next vehicle purchase that could actually make you money? Hi, I'm Rozdeba, the CEO of Dundas Life, and I'm about to show you an insider strategy that most financial advisors won't tell you about, using whole life insurance to help you buy a car. Whether you're looking for a lower interest rate or flexible terms, this is an approach that could offer a unique solution. In this video, we'll walk you through everything you need to know, so keep watching. Before we dive in, don't forget to subscribe to our channel for more informative and engaging content on personal finance in Canada. Most people think that paying cash for a car is the best option, but that's not always the case. When you pay for a car with cash, you're essentially giving up control over that money. That's right, the cash used to buy that car could have been working for you elsewhere, earning interest, compounding, and helping you grow your wealth. Instead, now it's parked in your driveway, losing value the moment you drive it off the lot. Think about it. That amount you worked so hard to save could be growing, earning you money. Now let's talk about financing. Sure, it sounds appealing to spread out the payments over time, but guess what? Those high interest payments eat into your budget, and at the end of the loan term, you're left with a depreciating vehicle without any savings to show for it. What if there was a way to have your money keep growing even after you've driven off the lot? That's where whole life insurance comes in. So how does it work? You fund an overfunded whole life insurance policy, which allows your money to grow tax-deferred over time. You can then borrow against the policy to buy a car, paying interest to the insurance company rather than to the bank. This way, your money continues to grow uninterrupted, and you have the flexibility to act on future opportunities. For example, let's say you have a whole life insurance policy with a cash value of $50,000. You can borrow against this policy to buy a car, and then repay the loan over time. Meanwhile, your original $50,000 continues to grow and earn interest, providing you a potential source of funds for future expenses or opportunities. Plus, when you borrow against your policy, you get to treat the repayment like a car note. You're essentially paying yourself back while your money keeps working for you. Let's talk about the advantages here. Your money keeps working for you even while you're driving your car. Plus, you can often negotiate a better deal at the dealership when you're essentially a cash buyer. It's a win-win. But what are the benefits of using whole life insurance to buy a car? For one, you maintain control over your capital, which can be more valuable than the cost of the interest. You can also have the potential to earn higher returns on your investment, which can lead to long-term financial growth. This strategy isn't a one-size-fits-all. Let's discuss how it can be used wisely to avoid common pitfalls. For one, there are interest charges on the loan, although they often compare favorably to traditional financing options. It's important to work with a knowledgeable insurance advisor, like ones at Dundas Life, to ensure your policy is structured correctly. Overfunding without a plan can lead to financial strain. You should also consider your individual financial situation, including your income, expenses, and debt obligations. By taking a thoughtful and informed approach, you can make the most of whole life insurance and achieve your financial goals. In some cases, you can get a car loan at a lower interest rate, say 2% from your credit union. It might be cheaper to go that route than to borrow from your policy. And be cautious overfunding a policy just to justify a car purchase, which could lock up your liquidity and create unnecessary financial strain. It makes more sense to use whole life as a part of a broader financial strategy, giving you funds you can access anytime, whether for a car purchase or starting a business or covering emergency expenses. So, how do you decide whether to use a whole life insurance to buy a car? Let's walk through the steps to help you decide if using whole life insurance to buy your car is the right move for you. Step 1. Decide what to buy. First, evaluate if the purchase itself is necessary. Can you truly afford it without stretching your finances too thin? Step 2. Decide how to buy. Next, consider all of your options: cash, traditional loans, life insurance loans. Look at the short-term costs like interest rates and long-term impacts, including opportunity costs. Step 3. Evaluate the cost of capital. Break down your costs into two components. On one hand, short-term costs. What is the interest rate for each option? Long-term costs. What opportunity cost does each funding source have? Step 4. Optimize efficiency. Now you might be wondering, when does a strategy make sense? Great question. Let's say you have a stable income and a good emergency fund. If you're in a position where maintaining liquidity is important, think potential investments or unexpected expenses, borrowing from your policy can provide that flexibility. Also, if you can borrow at a lower interest rate compared to what you could earn on investments, it makes sense to use your policy. For example, if your policy loan is at 5% interest, but you can invest elsewhere for a 10% return, well, you're effectively making money on the spread. Borrowing from a whole life insurance policy can be a lifesaver if you find yourself in a pinch with no other affordable loan options. Finally, if you can borrow at a lower rate and invest your policy funds for better returns, that may be the optimal route. Use life insurance as a foundational, asset-safe, secure, and liquid asset. Just remember, it's not a blanket solution for all your financial needs. And if you're feeling overwhelmed, don't worry. That's what we're here for at Dundas Life. We've helped hundreds of Canadians with finding the right life insurance for their needs. Let's look at some real-life examples to illustrate the benefits and potential pitfalls of using whole life insurance to buy a car. For instance, let's say you're a young professional who wants to purchase a car for $30,000. You have $20,000 in cash and a whole life insurance policy with a cash value of $20,000. You're considering borrowing against the policy to cover the remaining $10,000. In this scenario, you would need to weigh the costs and benefits of borrowing against your policy. On one hand, you would be able to purchase the car without depleting your savings or taking on high-interest debt. On the other hand, you would need to repay the loan over time, which could impact your cash flow and financial flexibility. To wrap it all up, using whole life insurance to buy a car can be a powerful financial strategy, but it requires very careful consideration and planning. Ready to start financing smarter? Click the link in the description below and let's design a financial strategy just for you. Our team of advisors will be happy to help you understand the benefits and potential pitfalls of using your whole life insurance to buy a car and provide you with personalized guidance and advice. Don't forget to subscribe to our channel for more informative and engaging content on life insurance and personal finance. Thanks for watching, and I'll see you on the next one.